1 candle, 2, and 3. If the market has moved lower, this candlestick in the middle, that is your kind of like your trigger candle. That's the one you're watching to see stay open. Number 2 candle is where your stop loss is. The conservative stop, the number 1 candle, is where your stop loss is. If the market price is down below here and you're looking for lower prices, even still lower than that, if the market trades up, this candlestick, number 3, this is your entry. That candlestick's high or 1 tick below it. If you're absolutely 100% certain that you believe strongly that it's going to drop, I will use a 1 tick below that candlestick's high. Now, you can do something like this. The low and the high, that is your consequent encroachment of this hypothetical fair value gap. So this to this candlestick's high, that's your sweet spot. This is your ideal entry point. So we've seen it go down into the lower half of this SIBI, which is a fair value gap that has a down close. It knocked out anyone that went short, traded down once more to the consequent encroachment, a mohawk, and trading up into that end all new day opening gap. Right here, the liquidity is this. That's your buy side. And then up here is mid gap or consequent encroachment of the opening range gap. So we have a small little gap in here. Notice it's over here. It's the same thing, just going lower. So we have a fair value gap there, and we have a fair value gap right there. This, to me, isolates all this price action. So I view this as a balanced price range. I would prefer it not to see that fill in. It doesn't mean if it goes down and fills it and touches this candlestick high or the small little volume bounce that has to be included. Like if you're drawing this fair value gap here, you can't just use the wick to wick like that. It's not valid. That's valid because you're taking in consideration that the difference between the two bodies, that they are not touching. So you have to have all the way down to the previous candle or number 1 candle in this case, which is the opposite of this. We want to see it trade above the end dog, come back down. It can use the top or the midpoint of that, spring from that up into the minor buy side, maybe hopefully accelerate and reach into that mid gap. 70% of the time, it's not 100%, 70% of the time, mid gap gets hit within the first 30 minutes. So back to this discussion here for fair value gaps. So since number 3 candle, that is your entry candle. Number 2 candle is your framing of the fair value gap. So as soon as the next candle, number 4, opens, you have a valid reason to anticipate a return back up into that fair value gap. It may not do so. It may just keep on dropping down. If it does, just let it do it, because your focus rather, should be in the mid part of the gap that is framed by this candlestick's low and this candlestick's high. If we're bearish, the ideal optimal entries are going to be formed at the lower half. Why? Because you want to see that upper half, this level up to this candlestick's low, stay open. Because if it does, that means you have a very strong probability that you're right and you're going to be on side. If, and it doesn't always happen, if it trades up in the upper half, in other words, it does this. Now we're up in the upper region. Now I have a real deep premium. I'm trying to sell at an extremely high price. As long as it's spending time up in here and it keeps tapping, and if it shows the body staying inside of this candlestick's low, number 1 candle's low, I will allow it to wick through that. And it's okay for it to do that because my stop loss is going to be resting 1 tick above this candlestick's high. It's going to take a real move to disrupt that. So if it's going to trade in above the midpoint and it's giving me a real high premium price, what price level am I going to aim for there? The upper quadrant level. So because we're using the volume imbalance here, that's how you would draw down to here, where I'm using the high here. If there is a volume imbalance, which is a separation between the previous candle body and the next candle that makes the fair value gap, that little separation, always include that. You'll have better determination of the consequent encroachment level, which is important. Like that's your most important level, because what you're watching for is you want to see the opposite of what I said earlier when we were looking at the sell or shorting opportunity for a fair value gap. We want to see the consequent encroachment in the lower portion traded to, and that's your best entry, because you want to see the upper half of it left open. And if it does, it means it's really bearish. Well, what do you think is going to happen on the times when you're bullish? The ideal entries are going to form in the midpoint of the gap to number 3 candles low. And you want to see that lower half stay open, not traded to. It can wick down in there. If it does trade to the midpoint, I'm going to add more. If it trades down to the lower quadrant, I'm going to add more. If I can see it touch this down here, I'm going to add more. I'm going to keep adding to that because my stop loss is going to be below candlestick number 2's low. Now apply that same logic over here. This number 2 candlestick, that's the fair value gap. The market drops down to this candlestick's price plus 1 tick. You would have been filled right there. And it went just short of what price level? That's that upper quadrant level. That price is 401.25. What is the low of that candlestick? 401.25. Did it leave the lower half of that gap open? Yes, it did. It didn't even touch the middle consequent encroachment level. So what does that mean? It's bullish. So that means you can trust that once it gets into this little new day opening gap up here, it's going to do what? It's going to accumulate. It's going to roll higher. So the best buys are in that upper half of that fair value gap because we want to see this portion, any candlestick that drops down in there. We don't want to see it spending a lot of time in there. We want to see one, at most 2 times, better if it's just once, entering it like that. And if it can start to run after going in just the upper half, feel confident that the lower half stays open for your benefit of knowing that you're on side. Now, does that mean you're never going to get stopped out? No, it just means that your confidence should increase and your level of uncertainty or the trepidation that you feel about potentially getting stopped out, it should be minimized as it moves further and further and further away from the fair value gap. I'm telling you that fair value gaps and anything that acts like an inefficiency, like a wick. If the wick is going to be bullish, we want to see the upper half of the wick keep price from trading into the lower half of the wick, regardless if the wick is above a candle's body or below a candle's body. It's the same thing. And if it's above market price, then that wick's going to be a premium array. If it's below price, then it's going to be a discount array. So if it's a discount array, the same thing I'm teaching you about the fair value gap, my PD arrays work with the wicks the same way. And look how fast it did it here. That's also a clue. As soon as the candlestick creates the fair value gap, if the next candle, number 4, drops in and he starts running, chances are stronger that this lower half will stay open. It could be a little bit of time before the market eventually comes back down into that fair value gap. And the same thing would appear in terms of the logic. So nothing changes there. But when they give it to you right away, that means it's going to be on a fast track to get somewhere quick. And that's the buy side I gave you over here. Okay. Why did I tell you at the beginning of the live stream that this was not a shorting opportunity? Well, we had started the morning consolidating. It spent a little bit of time meandering sideways, and then it broke initially right away. After it had already dropped from previous Friday's settlement price, we had already, if we would have opened back here at 906 or 849, that's significantly lower than Friday's settlement price. So we were already set up to have a big gap opening lower. And then if you have a lower gap opening that's in the cards and then you watch the 9:30 time window come to pass, and now here at 9:30, we open and they just send it lower, that's a Judas swing. You don't ever want to chase something like that. When you start seeing the market create a swing low, and then you right at that point, at that candlestick's close there, that opening, that's when I'm going back through all of this to look for inefficiencies, to look for order blocks, to look for anything like a short-term high where buy side would rest. Well, there is none of that in this. It's just a one straight shot lower. So that also is characteristic of a Judas swing. It's something fake. They're going to run right back over top of that. If you look at the range that was created on this drop down to that low, where is this inefficiency at? It's in the lower half of the price drop from the opening bell at 9:30 to create that swing low. And I seen that as soon as that candlestick closed and this one started trading, I said, okay, this one here is fake. And they rally it up into that, and they give you these little dojis and make you think, wow, it's going to drop. And I told you, nope, it's not going to drop. I'd rather see it trade higher. And once it trades higher, it can come back down in, but stay inside the upper half. We just saw a mohawk right there. It didn't go down to the lower half once it left it, that's the inefficiency model that I'm teaching you. That's how you know behind the scenes the algorithm is saying, all right, anybody that knows this information, quote unquote smart money, you're listening to them, they're going to expect that that's not going to trade lower. And then it starts to rally. Once it leaves this inefficiency, you have several things you can look for. A return back into the top of that inefficiency to treat that as a discount array. Or what do we have in price? What's in this area right here? What do you see? See that big wick? This candlestick leaves this inefficiency. So it's failed because it's in the lower half. Now, if this inefficiency was all overlapping candlesticks, but then this one was there, then I would say if it got to here, then I would look for it to sell off a little bit. But here we have the consequent encroachment of this wick. right there. So that means when this candlestick went up here and stopped, the next one we opened, it's reasonable to anticipate it to do what? Trade down to this candlestick's midpoint or consequent encroachment. To do what? To send price higher, because this is a discount array and price goes higher. And then we get that fair value gap that we've been talking about all morning. Now that I look at that, I just made a mistake. And you're probably all saying it and screaming, "That's not the first fair value gap," and you'd be right. I didn't look at the time. I'm sorry, it's my mistake. That's their very first fair value gap. It can't be on your 9:30 candle. It can only appear at 9:31 or after. So this is your very first fair value gap. But then they have that, excuse me, you have the gap that we've been talking about that's inside that. So that's kind of interesting, isn't it? But the targeting aspect of what you're looking for from where you expect price to run from to where it's going to gravitate to. In that first 30 minutes to 10 o'clock, you're always looking for an opportunity for it to try to get to the halfway gap. So consequent encroachment of the opening range gap, in my mind, that is my always first draw. I want to see that because there's a 70% chance that's likely to happen. If there's something before this level, like these smooth highs, the opening price, if you aimed for that, that's a good level. So because we're thinking it's going to go up to opening range gap, how can you use this inefficiency here? If you didn't look at the fair value gap like I outlined it when it was happening, and you were looking at this correctly, because I made the mistake of not recognizing that that was the 9:30 candle. The gap in here, this drop down into that fair value gap is also tapping into this gap, which is, if we're expecting it to go higher here, is this gap a sell? No. Why? Because the opening range gap midpoint or consequent encroachment is up here. It's still likely to be traded to. Here, what time is that? It's 9:48. What time is this candlestick when it would have gave you a buy based on everything we've been talking about in this live stream? It's 9:50. What is that? Macro time. 10 minutes to 10 to 10 minutes after 10. That's your macro. It's going to do what? Run to inefficiency or run to liquidity. Okay, well, we know that bias-wise, it's likely to draw up to half of the gap. How do you know which side of the market to trade on? It doesn't need to trade to these levels. 70% of the time is not 100% of the time. So how do you find something that's profitable in that model? If you see this as the first fair value gap, and I didn't even need to frame any of this on that. I was framing on the basis of watching this one form. So it just adds to it that is not necessary. But let's just say that you saw it as the first fair value gap, and we're expecting it to trade up to the opening range gap consequent encroachment midpoint and attack these smooth highs. Well, then you would expect it to trade through this gap here and do what? Find its support, treat it as a discount array, and rally higher.